Imagine the year is 1929. The air in New York City doesn't just hum, it thrums with an almost manic energy, the very sound of unchecked ambition poured into concrete and steel. The decade they called the Roaring Twenties is reaching its crescendo, a symphony of jazz, flapper dresses, and stock market tickers that seem to climb only one direction, up. Fortunes are made on a handshake, dreams are bought with borrowed money, and the American spirit, high on bootleg champagne and the promise of perpetual growth, believes it has finally tamed the wild beast of capitalism. People aren't just investing, they are gambling with a faith bordering on religious fervor, using margin loans, putting down a mere 10 cents to control a dollar's worth of stock, believing the dividend checks will always cover the interest, and then some. From the titans of industry, whose names grace skyscrapers, to the bootblack on the corner, everyone has a piece of the action, or knows someone who does. This isn't just finance, it's a national pastime, a collective fever dream where speculation has replaced savings, and the Dow Jones Industrial Average is the scoreboard for the nation's soul. Banks are overflowing, not just with deposits, but with the paper wealth built on this thin air of confidence. Yet, beneath the polished chrome and the laughter echoing from speakeasies, the foundations are beginning to subtly, almost imperceptibly, shift. A few quiet voices, ignored by the ticker tape parades, whisper of an inventory glut, of agricultural overproduction, of a dangerously inflated housing market, but their warnings are drowned out by the roar of the bulls. Our story, however, begins not with a crash, but with a faint tremor, a single, almost insignificant ripple that the market, in its arrogance, fails to notice. It's the last gasp of summer, the dog days of September, and the air is thick with the smell of exhaust fumes and impending change. Transition, focusing on the mechanism of the bubble ready to burst. Consider the sheer scale of the illusion. Millions of average Americans, swept up in the euphoria, have poured their life savings, their inheritances, even taking out second mortgages, into shares they don't truly understand. They are playing a game of musical chairs, but the music is about to stop, and there aren't nearly enough chairs. The true value of these companies, their factories, their actual profits, their tangible assets, is now dwarfed by the paper valuation driven purely by the expectation that someone else will pay more tomorrow. This is the essence of the bubble, hope multiplied by leverage. The mechanism itself is mesmerizingly simple and terrifyingly fragile. Imagine a pyramid built of playing cards, each card representing a stock, and the whole structure held up only by the belief that the next person joining the game will prop it up higher. What happens when that belief wavers? What happens when a few nervous insiders, sensing the unnatural height of the edifice, decide to cash out their winnings, taking their heavy foundational cards with them? The system wasn't designed to withstand a mass exodus of confidence. It was designed for perpetual ascent. The summer sees a few sharp downward spikes, brief panics quickly bought up by the optimists, who shout down the bears with renewed vigor. It's just a correction, they cry. A buying opportunity. But these dips are not corrections. They are the system testing its own breaking points, flexing against the immense, invisible pressure building within, setting the stage for the critical week. As October arrives, the tone in the financial district begins to sour. The easy money has slowed its flow. The margin calls, those dreaded notices demanding more collateral to cover shaky loans, start landing on desks like small, square grenades. A few respected, but not necessarily the biggest, players start selling significant blocks of shares, not in a panic, but with a chilling sense of finality. This isn't speculation anymore, it's a retreat. The whispers grow louder, turning into audible murmurs on the trading floor. The ticker tape, once running hours behind the actual trading due to volume, starts to fall further and further behind, creating a dangerous information vacuum. Traders, desperate for a true picture of the market's health, are forced to rely on outdated figures, guessing at the true price of their holdings while making decisions that determine solvency. This delay, this creeping fog of misinformation, is the invisible killer of Black Thursday. The sheer, unimaginable volume of sell orders is unprecedented, a floodgate opening in a system built for a slow, steady stream. The roar of the trading floor, which just weeks before was the sound of victory, starts to morph into something darker, something closer to mass hysteria. Picture the scene: the shouting, the desperate phone calls, the faces slick with sweat under the harsh electric lights of Wall Street. They are not trading. They are frantically trying to escape a burning building, only to find all the exits are jammed. The pressure is no longer on the value of the stocks, but on the liquidity of the market itself, the ability to turn paper into actual cash. And as the last few days of the month tick down, it becomes terrifyingly clear that the cash isn't there to meet the overwhelming demand to sell. The grand American party is about to end, not with a bang, but with the sickening, drawn-out screech of metal grinding against metal, the sound of billions of dollars evaporating into the cold October air. The stage is set for a week that will fundamentally rewrite the rules of American capitalism, a week where the phrase, "the world went broke," stops being hyperbole and becomes a brutal, daily reality for millions. The prelude is over, the storm is about to break over the canyons of Manhattan, and there is absolutely nothing anyone can do to stop it now. This is where the countdown truly begins. The morning of Thursday, October 24, 1929, arrived not with a quiet warning, but with a terrifying, primal scream. The opening bell on the New York Stock Exchange floor was meant to signal the start of trading, but today it sounded more like the shattering of glass. Before the trading day even officially began, the backlog of sell orders, literally millions of shares that had been frantically placed overnight across the nation, was so immense that it felt like trying to empty the Atlantic with a teaspoon. The first minutes were a dizzying plunge, a vertical drop that instantly wiped out the gains of months, even years. The Dow Jones Industrial Average plummeted by what would become 11% in intraday trading, a free fall that shocked even the most seasoned veterans. Imagine the trading floor, a concrete amphitheater of capitalism where sound and panic are now inextricably linked. The men, normally models of tailored composure, are reduced to shouting, desperate figures, their starched collars suddenly feeling like nooses. The sheer volume of selling, nearly 3 million shares changing hands in the first hour alone, was so overwhelming that the technology designed to manage the flow utterly failed. The critical failure of the ticker tape. The ticker tape, that mechanical ribbon of paper that was the lifeblood and truth serum of the market, could not keep up. It fell hours behind, the small, rhythmic clatter that usually provided calm now turning into a maddening, distant rattle. Investors across the country, in Chicago, Boston, and San Francisco, were watching the tape report prices that were already ancient history. They were selling based on prices from 10:30 a.m. while the actual price on the floor at 1 p.m. was devastatingly lower. This created a terrifying information vacuum, a fog of war where every sell order was a blind leap of faith into an abyss. Nobody knew the true value of anything, and in the absence of value, primal fear took over. The only certainty was that no matter the price, there were no buyers, only sellers. Giants of industry, General Electric, RCA, US Steel, were seeing their value crumble with every passing second, the losses measured not in thousands, but in billions. The margin calls, those little slips of paper demanding instant collateral from investors who had borrowed money to buy stocks, were flying across the floor, ignored in the chaos, adding fuel to the inferno. The emergency intervention by the bankers' consortium. Just before noon, the situation had deteriorated into something beyond a market correction. It was a systemic failure, a complete breakdown of confidence threatening to take the entire American banking structure with it. It was at this moment that the financial cavalry finally rode in. The great commercial banking titans of Wall Street, the veritable financial royalty like Thomas W. Lamont, acting head of J.P. Morgan and Company, Albert Wiggin of Chase National Bank, and Charles E. Mitchell of National City Bank, convened in a tense, closed-door emergency meeting at the House of Morgan. They were not driven purely by altruism. They understood that the collapse of the stock market would inevitably drag their own institutions down. Their consensus was clear. They had to inject massive, visible confidence. Their chosen emissary was Richard Whitney, the vice president of the exchange and a man whose presence commanded respect. Whitney, tall and impeccably dressed, walked onto the floor of the exchange and through the raging storm of panic with a startling calm. The dramatic moment of salvation and the temporary effect. In a dramatic, almost theatrical gesture intended for maximum psychological impact, Whitney walked over to the trading post for U.S. Steel, the benchmark American stock. With an audience of thousands of frantic eyes fixed upon him, he placed a single, colossal bid in order to buy 25,000 shares of U.S. Steel at $205 per share, a price significantly above the current falling market price. He then moved to other key stocks, placing similar, immense bids. This was not a business transaction, it was a public declaration of faith, a financial defibrillator jolt intended to break the cycle of panic. The effect was instantaneous and breathtaking. The shouting died down to stunned murmurs, then to a cautious sense of hope. The sight of the most powerful men in finance putting their collective money where their mouths were momentarily stanched the bleeding. Traders, seeing that there was finally a large, non-panicked buyer, began to cautiously pull back. The market rallied sharply from its intraday low, and by the closing bell, the Dow had miraculously recovered much of its 11% loss, closing down a more modest 2%. The immediate sense was one of exhausted relief. The headlines the next morning proclaimed the big boys had saved the day, that the market had demonstrated its resilience, that the crisis was merely a technical correction. For one brief, fragile Friday, the feeling was that the bubble had been gently deflated, not violently burst. But the truth, the chilling reality that only the most cynical observers understood, was that this rescue was a temporary patch, a magnificent piece of theater that had solved nothing about the underlying weakness. It had merely delayed the inevitable reckoning, allowing the great mass of indebted investors the weekend to contemplate their margin calls and the true cost of their borrowed dreams. The financial storm had paused, but the dark clouds over Manhattan were only getting heavier, promising a devastating deluge when the market reopened on Monday. The breathing room was an illusion, and the real terror was yet to come. The world was holding its breath, unaware that Black Thursday was only the prelude to something far, far worse. The reprieve granted by the bankers on Black Thursday was a magnificent, theatrical sleight of hand, not a cure. Friday, October 25th, dawned with an almost unnatural quiet, a financial stillness following the seismic shock of the previous day. The press, desperate for a story of salvation, breathlessly reported the heroics of Richard Whitney and the banking consortium, assuring the public that the fundamentals of business were sound, and that the market had merely purged itself of reckless speculation. The Dow, having been violently wrenched back from the precipice, did hold steady, even rising slightly as a few cautious, deep-pocketed investors tried to emulate the big banks, snapping up shares they believed were now cheap. For those who had bought on margin, the weekend offered a terrifying pause. It was 2 days of inescapable silence, 2 days for the reality of their deeply leveraged positions to sink in, 2 days to calculate the true impact of the margin calls that now sat like unexploded bombs on their desks. The fear was no longer centered on the stock prices themselves, but on the broker who held their collateral, the bank that held their loans, and the brutal arithmetic of the debt they now faced. Imagine the average investor, perhaps a schoolteacher, a doctor, or a shop owner, who had been assured by his broker that this was a guaranteed path to wealth. Now, he sat in his living room, unable to distract himself from the stark, typed numbers on the margin notice: sell immediately, or lose everything and still owe money. The temporary rally on Friday was nothing but bait, an artificial stabilization engineered by titans to protect their own interests, not the small investor's portfolio. The wealthy could afford to stand firm, confident that the system would always right itself for them. The small player, however, was now isolated, vulnerable, and facing a debt spiral with no way out. The slow realization over the weekend that the crisis is personal and inescapable. This weekend was a period of frantic, private desperation across America. Telegraph and telephone lines were jammed with calls to brokers, but the answers offered little comfort. More collateral was required, immediately, or their shares would be liquidated first thing Monday morning, regardless of the price. The panic began to spread from the canyons of Wall Street into the comfortable suburbs and the farmlands, transforming from a distant financial event into a crushing personal tragedy. The small-time speculators who had leveraged their life savings, and sometimes their entire network of friends and family, were now forced to choose between personal bankruptcy and selling everything they owned: houses, businesses, insurance policies, just to cover the broker's loan. This desperate scramble to find cash was the invisible pressure cooker that built up over Saturday and Sunday. They needed liquidity, but the banks were already tightening their belts, wary of the looming failures. The intervention by the consortium had saved the system on Thursday, but it had not refilled the empty wells of trust and credit. Instead, it had created a brief, deceptive window, allowing the inevitable counterattack, the forced liquidation of margin accounts, to be scheduled for the start of the next business week. The realization dawned on millions that the correction wasn't over. It hadn't even truly begun for them. The dread and the anticipation of Black Monday. As the sun set on Sunday, the atmosphere was thick with dread. The volume of outstanding margin debt was astronomical, and come Monday morning, the sheer, programmed necessity of liquidating these accounts to satisfy the debts would unleash a flood of selling that no consortium of bankers could possibly absorb. The bankers had used their psychological firepower on Thursday, and it was spent. The forces of individual, unavoidable obligation were about to overwhelm the collective willpower of the financial elite. The story now shifts from the dramatic crisis on the trading floor to the cold, mechanical process of market clearing. Monday, October 28th, would not be marked by confusion or the shock of the unexpected, as Thursday had been. Monday would be a cold, brutal, and calculated collapse, driven by the relentless, non-negotiable demands of lenders. Every nervous tick, every forced sell order from a liquidated margin account would drive prices lower, triggering yet more margin calls, creating a self-reinforcing, deadly loop. The entire nation held its breath, knowing that the real test, the true measure of the market's fragility, was scheduled for 9:30 a.m. on a day that would forever be known as Black Monday. The artificial dam holding back the torrent was about to break, and the floodgates of debt-fueled selling were ready to open with a force that would make the previous Thursday look like a mild tremor, unleashing the biggest single-day loss in history up to that point. The world watches, waiting for the bell that rings the doom. Monday, October 28, 1929, was the day the illusion of control finally shattered into a million pieces. This was not a panic driven by rumor, but a cold, hard collapse driven by the mechanical, unforgiving process of debt repayment. The market opened with an overwhelming flood of shares dumped by brokers forced to liquidate the margin accounts of small investors who could not meet their weekend calls. The volume was astronomical, eclipsing even Black Thursday's record. Traders on the floor, still reeling from the shock of 4 days prior, watched in horror as the market didn't just fall, it cascaded. The Dow Jones Industrial Average suffered a dizzying, record-breaking drop of nearly 13% in a single session, the largest single-day loss in history up to that point. The previous Thursday had been chaos. This was annihilation. The sheer velocity of the decline meant that every time a block of stock was sold to cover a margin loan, the price dropped, triggering more margin calls for other investors who held the exact same stock. This created a relentless, vicious cycle, the death spiral of debt-fueled speculation finally playing out in gruesome, rapid motion. The helplessness of the bankers and the failure of collective action. The very men who had played the hero on Thursday, Lamont, Mitchell, and Wiggin, could only watch in paralyzing helplessness. Their collective intervention had been a psychological tool, a one-time injection of confidence. But the scale of the debt-driven selling was now so vast, so pervasive across the entire market, that their combined wealth could not possibly stem the tide. Any attempt to buy, as Richard Whitney had done, would have instantly cost billions more than they were prepared to lose, only to see the stocks fall further moments later. The powerful financial system, which had seemed invincible just a week earlier, had revealed its fatal vulnerability to fear and leverage. The silence from the consortium itself became a new source of terror. On Thursday, their action had been announced with authority. On Monday, their deafening inaction signaled to everyone that the institutional support was gone, the life raft had pulled away, focusing on the victims outside the exchange. But the real tragedy unfolded far beyond the trading floor. Picture the thousands of brokerage offices and bank lobbies across the country, where bewildered investors watched the delayed ticker tape. They were seeing prices from 11 a.m., desperately holding onto their stock, unaware that the actual price on the floor at 3 p.m. was now fractions of that value. When their brokers finally contacted them, often hours later, the words were always the same: "Your account has been liquidated." The shock was instant and absolute. Their savings were gone, not just the profits, but the collateral, the borrowed money, and often they were left with a residual debt to the broker. The money they had used to buy a car, pay a child's college tuition, or fund their retirement was simply erased, vaporized by the merciless logic of the margin call. The dream of the Roaring Twenties, that anyone could become wealthy effortlessly, was brutally and permanently revoked. The psychological and societal impact beginning to register. The collapse on Black Monday was so complete, so decisive, that it instantly changed the atmosphere of the entire city and, soon, the nation. The confidence and swagger that had defined the decade vanished, replaced by a dark, cold realization. The boom was over, and the consequences would be paid not in abstract dollars, but in ruined lives. The shame and shock were immense. Successful, respected citizens who woke up wealthy went to bed utterly destitute, facing public humiliation alongside financial ruin. The psychological damage of having believed in the system, of having trusted the experts and the media, was profound. It was a mass betrayal of faith. Yet, astonishingly, the worst day in stock market history was still not enough to break the spirit of every optimist. A few desperate souls, clinging to the belief that things couldn't possibly get worse, saw the massive drop as the ultimate buying opportunity, betting against the overwhelming tide of fear. They poured their last scraps of capital into the market, believing they were catching a falling knife and would emerge richer. They were wrong. The market had yet one more brutal day of reckoning to unleash upon the world. The close of Black Monday was merely a pause before the final, cataclysmic blow, a financial execution that would take place the very next morning on a day that needed no introduction, Black Tuesday. The week of destruction was building to its terrifying climax, a climax that would forever define a generation. The night between Black Monday and Black Tuesday was not a night of rest, but a long, terrifying vigil. Across America, lights burned in the homes of investors, in brokerage offices, and in the war rooms of the banks. The realization was universal. The system had failed, the collective rescue effort had collapsed, and tomorrow would be the final, brutal act of liquidation. People weren't just calculating losses, they were calculating survival. The air was thick with a palpable sense of doom, the kind of stillness that precedes the eye of a hurricane passing over. Brokers spent the night executing the forced liquidation orders for millions more shares, ensuring that as soon as the bell rang, the market would be instantly overwhelmed. There was no longer a question of if prices would fall, but how fast they would hit zero. When the gong sounded at 9:30 a.m. on Tuesday, October 29th, the market didn't just resume falling. It exploded downward in a paroxysm of final, desperate selling that dwarfed the two previous days. The volume was unprecedented, a dizzying, nearly unbelievable 16.4 million shares traded, a record that would stand for decades. This was the final, total surrender of confidence, the moment when even the most stubborn optimists recognized the end. The sheer, overwhelming volume and the total breakdown of the market mechanism. Imagine the floor on Black Tuesday, pure, concentrated human hysteria. It was a physical, auditory manifestation of fear. Traders were literally fighting each other to execute sell orders, their voices raw, their bodies pressed together in a desperate, surging tide. The ticker tape, which had struggled on Thursday and Monday, now gave up completely. It lagged by hours, spitting out prices so divorced from reality that they were meaningless. In a grotesque twist, the lack of real-time information only intensified the panic. Anyone looking at the tape at noon might see a stock trading at $50, unaware that on the floor, it was already trading hands for $20. Brokers were forced to sell at market price, which meant whatever price they could get, even if that price was zero. Stocks of once indispensable corporations tumbled into single digits, their paper value reduced to dust in minutes. The psychological impact of seeing behemoths like General Electric, U.S. Steel, and Radio Corporation of America, RC, the glamour stock of the decade, crash to fractions of their September peaks was devastating. It was proof that no company, no matter how sound its underlying business, was immune to the tyranny of mass fear. The complete retreat of the buyers and the concept of unarticulated buyers. The crucial difference between Black Tuesday and all preceding panics was the complete, categorical absence of buyers. On Thursday, the bankers had intervened. On Friday, there was cautious hope. On Tuesday, there was no one left willing to catch the falling knife. Every single force, institutional, speculative, or retail, was attempting to sell. The market became a purely one-sided transaction, a destructive auction where sellers desperately dropped their prices, only to find the buyers had evaporated. The sheer velocity of the selling created moments where certain stocks were essentially untradeable, momentarily vanishing from the market because no one would even bid a single dollar. This was the ultimate realization of the bubble. The paper wealth was meaningless without someone else willing to trade cash for it. And now, the cash was gone, sucked dry by the relentless margin calls. The brokers and lenders, having forcefully liquidated their clients' accounts, inadvertently guaranteed the final destruction of the market they sought to protect. The day ends, but the reckoning begins. When the final bell rang on Black Tuesday, it was not a moment of relief, but a moment of profound, exhausted silence. The floor was littered with paper, the sound of 16.4 million shares being destroyed. The cumulative loss for the day alone was estimated at over $14 billion, an unfathomable figure at the time, exceeding the entire cost of the American participation in World War I. The 4 days, Thursday, Monday, Tuesday, had seen a 25% drop in the Dow, wiping out the gains of the last 4 years. The crash was complete, but the economic impact had only just begun. The paper losses of Wall Street would quickly translate into the tangible horrors of the Great Depression: factories shutting down, bank runs, unemployment lines, and the death of global trade. The week the world went broke was over, but the decades of paying the price were about to begin, ushering in an era of profound hardship, forever linking the abstract numbers on a ticker tape to the deepest struggles of the human condition. The curtain had fallen on the roaring Twenties. The immediate silence that followed the closing bell on Black Tuesday was the quiet before the next, even more terrifying storm. The world had gone broke on paper, but now, the abstract losses of Wall Street had to be paid in the brutal currency of Main Street. This was the moment the financial contagion left the exchange and began to infect the real economy. For weeks, the press and the financial elite had insisted that the stock market was separate from business fundamentals. They were tragically, profoundly wrong. The first sign of this lethal connection came not through a ticker tape, but through the banks. Millions of average investors, now wiped out, were suddenly unable to repay their loans. Not just the margin loans to brokers, but the personal loans they had taken out against their homes and businesses, loans that now sat on the books of thousands of local banks across the country. The slow, terrifying spread of the banking crisis. The banks, which had initially profited immensely from financing the speculative boom, now found themselves holding mountains of toxic debt. Worse, the crash had ignited a deadly fear in the heart of the ordinary citizen. If Wall Street could vanish overnight, could my bank deposits vanish too? This fear quickly manifested as the terrifying phenomenon of the bank run. Imagine the line, not the desperate, frantic mob sometimes depicted, but a slow, orderly, yet utterly determined queue stretching around the block, composed of hardworking people quietly asking for their money back. They weren't demanding, they were simply protecting the last few dollars they had left. But the banking system of the 1920s was built on the fundamental assumption that not everyone would ask for their money back at once. Banks only held a small fraction of deposits in cash reserves, lending out the rest. When the queues started moving, the banks quickly ran out of physical currency. The result was instantaneous. One by one, doors closed, shutters came down, and signs went up declaring the bank insolvent. For the depositors in that line, the closure meant not just a temporary inconvenience, but the total, irrevocable loss of every penny of their savings, as there was no federal deposit insurance at the time. The losses were no longer just paper, they were tangible, immediate, and utterly personal. The halt of industry and the first wave of unemployment. The bank failures immediately paralyzed the engine of American industry. Factories, suddenly unable to secure short-term loans or lines of credit because the banks had no money to lend, were forced to halt production. Without credit, businesses couldn't buy raw materials or pay their workers. The ripple effect was swift and devastating. Companies that had been expanding rapidly during the Roaring Twenties suddenly announced massive layoffs. The proud, busy factory gates that had symbolized American industrial might now stood padlocked. The lines of the unemployed began to form, not outside brokerage offices, but outside soup kitchens and municipal employment bureaus. This was the true moment the Great Depression began, when the financial collapse triggered mass unemployment, transforming a capital crisis into a humanitarian crisis. The money supply itself contracted violently, deflation set in, and prices dropped. But with no jobs, nobody could afford to buy anything anyway. The nation was trapped in a self-reinforcing downward spiral where fear fueled bank runs, which fueled factory closures, which fueled job losses, which fueled greater fear. The stunned reaction of political and financial leadership. President Herbert Hoover and his administration initially responded with a mix of denial and cautious optimism, echoing the earlier, failed statements of the bankers. They believed the market had simply corrected its excesses and that the inherent soundness of the American system would quickly reassert itself. They called conferences, issued hopeful statements, and urged business leaders not to cut wages or fire workers. But their words were utterly powerless against the cold, hard force of economic reality. They had underestimated the destructive power of mass fear combined with mass debt. The financial crash had been the opening salvo, a week of destruction. Now, the battle for survival had moved to the streets, and the leaders had no weapons, no effective policies, no safety net, and crucially, no understanding of how to restore the vanished confidence of the American people. The era of reckless optimism was dead, replaced by a bleak landscape of breadlines and bankruptcies, a generation forever marked by the sound of the stock market's final, deafening crash. The long, dark decade had begun. The ultimate price was about to be exacted. The immediate silence that followed the closing bell on Black Tuesday was the quiet before the next, even more terrifying storm. The world had gone broke on paper, but now, the abstract losses of Wall Street had to be paid in the brutal currency of Main Street. This was the moment the financial contagion left the exchange and began to infect the real economy. For weeks, the press and the financial elite had insisted that the stock market was separate from business fundamentals. They were tragically, profoundly wrong. The first sign of this lethal connection came not through a ticker tape, but through the banks. Millions of average investors, now wiped out, were suddenly unable to repay their loans. Not just the margin loans to brokers, but the personal loans they had taken out against their homes and businesses, loans that now sat on the books of thousands of local banks across the country. The slow, terrifying spread of the banking crisis. The banks, which had initially profited immensely from financing the speculative boom, now found themselves holding mountains of toxic debt. Worse, the crash had ignited a deadly fear in the heart of the ordinary citizen. If Wall Street could vanish overnight, could my bank deposits vanish too? This fear quickly manifested as the terrifying phenomenon of the bank run. Imagine the line, not the desperate, frantic mob sometimes depicted, but a slow, orderly, yet utterly determined queue stretching around the block, composed of hardworking people quietly asking for their money back. They weren't demanding, they were simply protecting the last few dollars they had left. But the banking system of the 1920s was built on the fundamental assumption that not everyone would ask for their money back at once. Banks only held a small fraction of deposits in cash reserves, lending out the rest. When the queues started moving, the banks quickly ran out of physical currency. The result was instantaneous. One by one, doors closed, shutters came down, and signs went up declaring the bank insolvent. For the depositors in that line, the closure meant not just a temporary inconvenience, but the total, irrevocable loss of every penny of their savings, as there was no federal deposit insurance at the time. The losses were no longer just paper, they were tangible, immediate, and utterly personal. The halt of industry and the first wave of unemployment. The bank failures immediately paralyzed the engine of American industry. Factories, suddenly unable to secure short-term loans or lines of credit because the banks had no money to lend, were forced to halt production. Without credit, businesses couldn't buy raw materials or pay their workers. The ripple effect was swift and devastating. Companies that had been expanding rapidly during the Roaring Twenties suddenly announced massive layoffs. The proud, busy factory gates that had symbolized American industrial might now stood padlocked. The lines of the unemployed began to form, not outside brokerage offices, but outside soup kitchens and municipal employment bureaus. This was the true moment the Great Depression began, when the financial collapse triggered mass unemployment, transforming a capital crisis into a humanitarian crisis. The money supply itself contracted violently, deflation set in, and prices dropped. But with no jobs, nobody could afford to buy anything anyway. The nation was trapped in a self-reinforcing downward spiral where fear fueled bank runs, which fueled factory closures, which fueled job losses, which fueled greater fear. The stunned reaction of political and financial leadership. President Herbert Hoover and his administration initially responded with a mix of denial and cautious optimism, echoing the earlier, failed statements of the bankers. They believed the market had simply corrected its excesses and that the inherent soundness of the American system would quickly reassert itself. They called conferences, issued hopeful statements, and urged business leaders not to cut wages or fire workers. But their words were utterly powerless against the cold, hard force of economic reality. They had underestimated the destructive power of mass fear combined with mass debt. The financial crash had been the opening salvo, a week of destruction. Now, the battle for survival had moved to the streets, and the leaders had no weapons, no effective policies, no safety net, and crucially, no understanding of how to restore the vanished confidence of the American people. The era of reckless optimism was dead, replaced by a bleak landscape of breadlines and bankruptcies, a generation forever marked by the sound of the stock market's final, deafening crash. The long, dark decade had begun. The ultimate price was about to be exacted.